Picture someone who is short on cash a few days before payday. A bill is due now. The money arrives later. Then they see an offer. Quick cash, no long approval, just pay it back on your next paycheck. It sounds like a small bridge over a small gap. But payday loans are one of the most expensive forms of borrowing that exist. Let us slowly unpack why. A payday loan is a small, short-term loan, usually meant to be repaid by your next payday. The amounts are often small. The approval is often fast and does not always depend heavily on credit history. In exchange for that speed and easy access, the cost is extremely high. The convenience is real, but it is paid for very steeply. The fee may look small at first glance. A fixed charge for borrowing a modest amount for a couple of weeks can seem almost reasonable in the moment. But when you translate that short-term fee into an annual cost, the effective rate is often staggering, far beyond what most credit cards or personal loans charge. The short time frame hides just how expensive it really is. But the headline cost is not even the worst part. The deepest danger of payday loans is the rollover, sometimes called the cycle of debt. Here is how it begins. The loan comes due on payday. But repaying it in full leaves the borrower short again. So they pay another fee to extend, or they take a new loan to cover the old one. Let us walk through how the trap tightens. Imagine someone borrows to cover a gap. Payday arrives, but the full repayment plus the fee would leave them unable to cover this month's bills. So they roll the loan over. Now they owe again, plus another fee. The original gap never closed. It just moved forward in time, and it grew on the way. This is the cruel logic of the cycle. Payday loans are often used by people who are already financially stretched. The repayment is designed to be due in full very quickly. For someone with no cushion, repaying in full almost guarantees another shortfall. So the very people most likely to use these loans are the most likely to get caught rolling them over. Over months, the numbers can become heartbreaking. A person might end up paying far more in fees than the amount they originally borrowed, and still owe the original sum. The debt did not shrink. It simply generated fee after fee. This is why payday loans are widely described as one of the most dangerous corners of consumer borrowing. Many payday lenders also ask for access to your bank account or a post-dated authorization, so repayment can be pulled automatically. This can lead to a second layer of harm. If the account does not have enough money when the lender tries to collect, the borrower may also face overdraft fees from their own bank, stacking more cost on top of an already expensive loan. It is worth being honest about why people use these loans anyway. They are not foolish. They are often facing a real, urgent need. A utility bill, a car repair to keep getting to work, a medical cost. The payday loan feels like the only door open at that moment. Understanding this is important, because the solution is not shame. It is alternatives and planning. So what are the alternatives? Before a payday loan, it is worth exploring several options. Asking the biller directly for an extension or a payment plan. Checking whether an employer offers an advance on earned wages. Looking into small loans from a credit union. Borrowing modestly from family with clear terms. Even a credit card, expensive as it is usually far cheaper than a payday loan. The most powerful long-term protection, though, is an emergency fund. Even a small buffer changes everything. The reason payday loans work as a business is that many people have zero cushion. Building even a modest emergency fund, slowly and steadily, removes the desperation that payday lenders depend on. It turns a crisis into a minor inconvenience. If someone is already caught in a payday loan cycle, the first step is clarity, not panic. List exactly what is owed, to whom, and when each payment is due. The goal is to break the rollover pattern, even partially. Sometimes that means negotiating directly with the lender. Sometimes it means seeking help from a reputable nonprofit credit counseling resource for a structured plan. Be very cautious of one tempting move, taking a new payday loan to pay an old one. It feels like progress, but it usually deepens the trap. Each new loan adds new fees and resets the same impossible timeline. Breaking the cycle almost always requires finding money from outside the payday system, not from another payday loan. There is also an emotional dimension worth naming. The stress of payday debt can cloud judgment, making people avoid opening statements or answering calls. But avoidance lets the situation grow. Facing the numbers, even when they are frightening, is the first real step toward control. The debt feels smaller once it is fully visible and written down in plain sight. Prevention is always cheaper than escape. A few habits dramatically reduce the chance of ever needing a payday loan. Build a starter emergency fund, even if it grows slowly. Track your bills so due dates never surprise you. Trim recurring costs to widen your monthly margin. Know your alternatives in advance, before a crisis, so you are never choosing in a panic. It also helps to recognize the marketing. Payday loans are often advertised with words like fast, easy, and no credit check. Those words describe the access, not the cost. The harder a lender works to emphasize speed and ease while staying quiet about the true price, the more carefully you should read what borrowing will actually cost you over time. None of this means a person in a hard moment has failed. Financial emergencies happen to careful people too. The point is simply this: payday loans are rarely the bridge they appear to be. More often they are a steep, narrow ledge that is easy to step onto and very hard to step off. Knowing that in advance is itself a form of protection. So here is the short version. A payday loan is a small, fast, very expensive short-term loan, and its real danger is the rollover cycle that can trap borrowers for months. Before ever using one, explore payment plans, credit unions, employer advances, and other options. And build even a small emergency fund. The best way to survive a payday loan is to never need one.